Hello, I'm David Rubenstein, President of the Economic Club of Washington, D.C., and I'd like to welcome everybody to our 17th virtual event of our 35th season. Today, our special guest is the Honorable Jerome H. Powell, Chairman of the Board of Governors of the Federal Reserve System. And now it's my pleasure to welcome Jerome Powell, J. Powell, to our conversation. Thank you very much for being here, Chairman Powell.
Thanks, David. Great to be here.
So let me begin by talking about the state of the economy. Your public statements to date in recent interviews makes it sound like you feel the economy is in reasonable shape to go forward from here, and you're expecting growth of 5 to 6% this year. Is that a correct announcement of your views?
Generally, yes. I would say that the economy at this point does seem to be at a bit of an inflection point, and that makes sense with ever more widespread vaccinations, with strong fiscal policy, with continued support for monetary policy. You see the economy opening. You can see ridership on airplanes going up and people going back to restaurants. I think the March jobs report that we recently got shows what that can look like, which was close to 1 million jobs in a month. So I think we're going into a period of faster growth and higher job creation, and that's a good thing. I would point out there's still risks. In particular, I would say the main risk is that we'll have another spike in cases, perhaps in one of the virus strains that may be more difficult to treat. Now, we don't see that yet. We do see cases having moved up a bit, but that's something we need to be careful about, and I think we'd be wise to keep wearing masks and being socially distant at least for a while longer.
Okay, when the Fed does its analysis of the economy, you now have to look at things like vaccination rates. Do you have internal experts that give you that kind of information of whether the vaccination rates is going the way it's supposed to, or do you consult outside people for that kind of information?
Well, we do have experts now. I would tell you a year ago, we've had to learn it. So this was by far the most important economic policy in this entire event has been medical policy. It's been the treatment of the disease and the successive measures to suppress its spread, and then ultimately vaccination. So that's been the most important driver of the economy. We, of course, all through this have consulted externally with lots of experts, but we've also developed significant in-house expertise over the course of now more than a year. So we do monitor that still very, very carefully, of course.
So let's talk about the president's stimulus bill, the $1.9 trillion stimulus bill. At the time that it was proposed, Larry Summers, a former Secretary of the Treasury, said that he thought it might be too big. It might be somewhat inflationary. It was the output gap is roughly $500 billion. This was $1.9 trillion. You, I believe, supported the legislation, thought it was appropriate for the economy. Do you have any concern that we are going to be producing inflation as a result of the stimulus bill, or do other things that might get you to be more worried about the economy because of the size of that stimulus bill?
So we, at the Fed, we have very specific jobs. We're a creature of statute, and we have very specific jobs that we handle that Congress has given us, and that's for monetary policy. It's stable prices and maximum employment. We also supervise and regulate banks. We deal with the payment systems and all that. One thing we don't do is give Congress or the administration advice on fiscal policy. So I've never, and we don't traditionally take a position in favor or opposed to legislation. We didn't do that for the Tax Cut and Jobs Act, and we didn't do it for really any of these acts. That's just not something that we do. We have a narrow mandate and precious independence, so we try to stay in our lane and not comment on things that Congress might do on fiscal policy.
Okay. Well, let's just talk about, let me try it another way. Are you worried about debt and deficits? The debt is pretty high, 27 trillion or so, and the annual deficit is now about 2.5 to 3 trillion or so. Is that a concern to the Fed in terms of impacting inflation?
So yes, in the over time and in the longer run, the U.S. federal budget is on an unsustainable path, meaning simply that the debt is growing meaningfully faster than the economy, and that's by definition unsustainable over time. It's a different thing to say that the current level of the debt is unsustainable. It's not. The current level of the debt is very sustainable, and there's no question of our ability to service and issue that debt for the foreseeable future. I would also say, though, that as a nation, we will have to eventually get back to a sustainable path. That is something that is best done in very good times when the economy is at full employment and when taxes are rolling in. This is not the time to prioritize that concern, but it is nonetheless an important concern that I believe we will ultimately have to return to again when the economy is strong.
Now, you have previously said, I just want to ask you if you feel the same way now, that currently you do not expect the Federal Reserve to increase interest rates before the end of 2022. Is that a correct view of what you've said?
So here's what we've said. We've said that we would expect to keep interest rates where they are today until three particular outcomes are achieved in the economy. The first is that the recovery in the labor market is effectively complete. The second is that inflation has reached 2% and really reached it, not just sort of tapped the base, as I like to say, but has reached it sustainably. And the third thing is that inflation is on track to run moderately above 2% for some time. Those are the tests. So we are really focused on the progress of the economy toward those goals and not on a particular time frame. When we get those three boxes checked, that's when we'll consider raising interest rates, and that's when we'll raise interest rates. Until then, we won't. So what you're referring to, I think, is we all write down these projections every quarter in the March, June, September, and December FOMC meetings, write down individual projections, and we submit those, we tabulate them and publish them. And most members of the committee did not see raising interest rates until 2024, but that isn't a committee forecast. It isn't something we vote on or act on as a group. It really is just our own assessment. And so I think there's a tendency of markets to focus too much on what we call the dot plot, the summary of economic projections. And I would focus more on the outcomes that we've described and the best assessment we can make of our progress toward achieving those.
Okay, but based on what you know today, you would not expect to increase interest rates before 2022, or you're just not saying that yet?
Well, before 2022, that would be this year. I think that would be highly unlikely. I don't talk about particular date. I don't think there's any use in that. So, but it really is outcome based.
Okay, let me ask you, last time the Fed did increase interest rates, it did so by a little bit, and then it started shrinking its balance sheet a bit. Do you have any view on whether that's the right way to proceed when you begin to increase interest rates? Should you increase interest rates and then shrink the balance sheet later, or should you begin to shrink the balance sheet and then increase interest rates? Do you have any view on whether one policy or the other is better?
So what we did after the global financial crisis was first we were buying assets, and then we gradually slowed the pace at which we were buying treasuries and mortgage-backed securities, and then we held the balance sheet constant for a while. After that, we started raising interest rates. We raised them gradually, and at some point we held the balance sheet constant. So we don't sell bonds into the market, and we either, when they mature, we either reinvestment or whether we allow them to run off. So that's what we did last time. I think if you look at the sense of our guidance, it is that we will reach the time at which we will taper asset purchases when we've made substantial further progress toward our goals from last December when we announced that guidance. And that would in all likelihood be well before the time we consider raising interest rates. We haven't voted on that order, but that is the sense of the guidance, is that it would work in that way.
In other words, you are likely to follow the same policy of not selling into the market the bonds you already have or other securities, but just let them mature, and then that's the way you'd shrink your balance sheet. Is that right?
These are questions which lie ahead of us, but essentially, though, I would say it this way: the first thing we do is we say that we will gradually reduce the pace of our purchases, and then when the purchases go to zero, the size of the balance sheet is constant, and when bonds mature, you reinvest them. Now, then another step, and we took this late in the day, the last cycle, was to allow bonds to start to run off. And we haven't decided whether to do that or not. We didn't then, and I don't think we now would ever actually sell bonds into the marketplace.
Okay, let me ask you a little bit about the FOMC. People probably don't really know how it works that much, but how many members are there of the FOMC?
So all 12 Reserve Bank presidents and all of the sitting governors, which is currently 6, are what we call participants in the FOMC. So it's the Federal Open Market Committee, and we meet 8 times a year. We're doing it virtually now, but I do it from this beautiful boardroom we have upstairs. So all of the governors vote at every meeting. That's the 6 of us. And then 5 of the Reserve Bank presidents vote on a rotating basis on a 2 or 3 year cycle, depending on which district you represent, except the New York Fed president always votes as well. So it's a little bit complicated, but the sense of it is that it's a balance between the reserve banks, which are all around the country, and the board, which is here in Washington, D.C., and is nominated by the president and confirmed by the Senate.
Okay. So in the Supreme Court, when they have conferences among the members, I think the Chief Justice gives his view first, and others, according to seniority, give their views. How does it work at the FOMC? Does the chairman of the board, you, give your views first, or do others speak and then you give your views?
It really depends on the issues and what we're talking about, and you know, it's sort of up to me. The order changes. It's not an order of seniority or anything like that. People say, let's say we're going to have a go around on the economy. People will say, I'd like to go in the middle. I'd like to go at the beginning. I'd like to go at the end. And we sort of make up a list and we hand the list around. So I will sometimes go first if I really want to make a point. Often I'll go last and I'll try to sum up and then say what I think the path forward is. It really depends on the situation.
Okay. I always worry about the secrecy. So I assume that you have somebody coming in and sweeping the room where all these discussions are going to occur, or when they're being done virtually, you have the best cyber people in the world to make sure that nothing leaks out. Is that correct?
That is correct. You know, of course, we realize that we're a very attractive, target for hacking and cyber attacks of all kinds. And so we invest a great deal of time and money in trying to make ourselves as safe as possible. We also have very strict rules for FOMC participants and their staff for the handling of confidential materials. I would just say you never feel like you've done enough. I'm sure you feel the same way. In business, you just never feel like you've done enough. But we try very hard to be as robust against those kind of penetrations as possible.
Okay, so let me ask you about the situation with respect to a couple issues you've talked about, climate change, for example, or racial inequality. The Fed has not historically been somebody that's supposed to be focused on climate change, and you're focused on the unemployment rate, but not under the statute, whether it's minority unemployment rate or white unemployment rate. How do you assess those issues? Do you get criticized from members of Congress when you say we have to worry about, or if you do say that, climate change or its impact on the economy? How do you assess these issues that are not really in your statute, but are now important in terms of determining how the economy is moving forward?
So they're two different issues, and there are differences and similarities. So I'll talk about them in order. So but the point is, both of them we see only through the lens of our existing mandates. We haven't gotten any new mandates. So take climate change, for example. The reason we're focused on climate change is that our job is to make sure that financial institutions, banks, particularly the largest ones, understand and are able to manage the significant risks that they take. And the public will expect us to do that. Climate change is just another one of those risks. And increasingly, the large banks very much realize that. If you talk to leaders of these large financial institutions, they're very focused on what climate change is going to mean for their business model over time. So it's within the scope of that mandate. In addition, we have responsibilities for the broader financial system. How will climate change affect the broader financial system and markets? And so we see it only through the lens of that existing mandate. It's similar with inequality. We have these persistent disparities, racial, gender, and other disparities in economic outcomes in our economy, and they kind of hold the economy back. You know, we all want an economy where everyone has the ability to contribute to and benefit from prosperity that we have in our great economy. So really, our focus is on the gaps that we face, and we call them out. We talk about them. We've tried to incorporate into our monetary policy framework the thought that maximum employment, our statutory goal, is a broad and inclusive goal. That's a reference to those issues. And also, I think we now realize that unemployment can go low for quite a long time without inflation being a problem, which will also tend to help those groups. On that, I would just stress, of course, we can't be the primary policy organization that treats either climate change or inequality. We see it through the lens of our existing mandates, but those are very much issues for elected representatives and for other parts of the government. more than they are for us.
You mentioned inflation. Let me talk about that, or ask you about inflation. The Fed for quite some time has tried to get 2% inflation, but really hasn't been able to get 2% inflation in our economy. Why do you think it's been so difficult to get inflation at 2% or higher? When I worked in the government many years ago, we had double-digit inflation. I don't think we're getting that again. But why is inflation so hard to get when we have large deficits and a lot of government spending?
The economy has really changed since those days. That's when I was in college. And I think people generally attribute the quarter of a century of low inflation that we've had to a number of factors. One is globalization, one is spread of technology, another is demographics and the aging population. All of those tend to lead to lower inflation. So what we have, in fact, since the global financial crisis for the last decade, you've seen central banks around the world really struggle to reach a 2% goal, and in some cases, are fighting outright deflation. The reason that's a difficult thing is that reduces the scope of central banks to react to the economy when it turns down, which can lead to still weaker economic outcomes, lower interest rates, lower inflation. So you can get into a cycle, if you will, that's not a productive one. So we really want inflation to be at 2%. We want it to average 2% over time. And that means that we want to overshoot 2% after we've been through a period moderately and for some time after we've been below 2% for a while.
Well, as you know, bond traders tend to focus on every nuance of everything you say. And so they tend to sometimes exaggerate what you might have meant. But make sure I understand and everybody watching understands, if inflation were to go a little bit above 2% over the next year or so, you wouldn't regard that as a calamity. Is that fair?
So we seek, because inflation has run below 2% for some time, we seek inflation that is moderately above 2% for some time. That's our objective. Now, when you say moderately, that means moderately. We're not going to put numbers on it, but so we'd be comfortable for, indeed, we seek inflation that is moderately above 2%, and that's very well known. And so for quite some time, many people were saying, well, you'll never get above 2% because it has been very hard to get back to 2%. Now more of the discussion is on the other side, as you know.
So you are the first person in quite some time to be the chairman of the Fed who was not a PhD in economics. I think the last one might have been, I think Paul Volcker didn't have a PhD, but he was trained as an economist. But since that time, you've had trained economists. You've been trained as a lawyer. Is that why you are able to speak in the King's English much better than the economists who've had that job? Because you tend to speak in ways that people actually can understand. Is that a conscious effort, or you just didn't learn how to speak like an economist and therefore you're more easily understood?
So I do consciously think it's very important to speak to the interested public in a way they can understand and to avoid jargon. So every discipline has jargon, and it's a way members of that discipline speak to each other to be very precise about what they mean. But when you use it with the general public, it's just annoying, it's irritating, and it's exclusive, it feels bad. So I try very hard to avoid using jargon. And I do think, I think if you look at surveys, you've seen these, large public and private institutions around the world are really struggling to hold the faith and support of the public. And I think for the Fed, it's terribly important that we do engage with the public proactively. We don't look at this as something we got to do. It's absolutely essential to what we do is to speak to the public and the public's elected representatives in Congress a lot, and sort of gain our democratic legitimacy through that. We need accountability, we need democratic legitimacy, and to do that, we've got to speak clearly and transparently.
I've known a number of your predecessors, and I wouldn't say they relished dealing with members of Congress. It wasn't the part of the job they liked the most, but you seem to actually, don't dislike it. You've talked to a lot of members on both sides. Is that a conscious effort to talk to more members of Congress than maybe some of your predecessors? And do members of Congress tell you all the time, you should be doing this or that? And how do you respond when, you're trying to be polite to them?
It was very conscious, but part of it just was after the hard work done by, Ben Bernanke and Janet Yellen and everyone who was involved to get the economy back to a better place and get the Fed back to a better place. I thought there was an opportunity to really raise our engagement, and I have, and so I do spend a great deal of time. I actually enjoy it. I go into people's offices and I say, I want to hear what's on your mind, and I think they really do appreciate the dialogue and all that, and I appreciate it too. I feel like I learn about them, and they tend to be very interesting people, and they're interested in what we do. So it seems to work, and I'm certainly going to keep doing it.
So when I go see members of Congress from time to time, I sit in their waiting room for quite a while to get in. Do you spend more than 30 seconds in a waiting room, or that 30 seconds will be long?
It happens all the time. Sometimes you go up there and they're voting, and you sit there for an hour, and they can't go, and you go back, and it's fine. That's just part of the deal. We work for them. I mean, we're a creature of Congress. We were effectively the House Financial Services Committee and the Senate Banking Committee are the statutory oversight over this agency in our government. So I take that very seriously. We take our relationships with them seriously, and we want to understand their concerns, and we work hard at that.
Now, as you pointed out earlier, there are 6 members of the Federal Reserve. There's supposed to be 7. We haven't had 7 for quite a while. Do you recommend a 7th person to the president, or do you stay out of that? And how does the Fed operate without 7? It hasn't had 7 for a long time. Do you think it's okay to operate with 5 or 6?
It's certainly okay to operate with 5 or 6. So we were down to 3 for a while. I would say that was more like we had to go to zone defense. That was very, very difficult. But with 5 or 6, we're fine, and with 7, we're fine. The way it works, though, is of course the president has the right of nomination. The Senate has the right of confirmation. We have no official role to play whatsoever. As a matter of courtesy, traditionally, administrations have, after they've vetted candidates, they will, perhaps send that candidate to be a governor over to meet with the Fed chair. It's strictly in their discretion to do that or not, but they have often done that. And then the Fed chair, really, they're not asking you to identify people. They're saying, is this person okay? And you sort of have a nice interview with them and give them your answer. So that's the way it's been traditionally, but really we have no official role, and it's completely up to the administration whether they want to do that or not.
So I don't think we've ever had a case where a chairman of the Fed later became Secretary of the Treasury, and somebody who was on the Fed board later became chairman of the Fed, like you have. And so is it a little awkward to be kind of in a situation where your former, let's say, chair is now the Secretary of the Treasury, or does it make it easier because you know her so well?
It's not awkward at all. So I think, I worked at Treasury and I've worked at the Fed. Secretary Yellen worked in the White House on the council. She's chair of the Council of Economic Advisors. And I think both of us understand that Fed and Treasury have different authorities and different roles, but have a long history of institutionally working together for the good of the country. And so we respect each other. We respect the lines very clearly, clear lines, stay in your lane kind of thing. And I think we'll have exactly that kind of we do have exactly that kind of a relationship. I mean, I have no concerns about that at all. And
how do you relate to the administration? Typically, chairs of the Fed will have a regular lunch with the Secretary of Treasury. Sometimes even the President of the United States will have some regular contact. How are you relating to this administration? Do you meet with the Secretary of Treasury regularly, or people on the White House staff, or the President? How are you doing that?
So I think the way the sort of standard way it's happened has been this, that there's a weekly, it had been a breakfast or a lunch between the Secretary of the Treasury and the Fed chair, and it rotates back and forth into each building. That's now a phone call. And so that's what I've been doing with Secretary Yellen. In addition, there's been an irregular but roughly monthly lunch with the head of the National Economic Council. So there's a relationship there. Meetings with presidents and Fed chairs are very, very, very infrequent and not on any sort of a schedule. So I have not met with the president.
Had you met him before he was president? You must have met him at some point in his life or your life, or you really haven't met him yet?
I think I've shaken his hand, but I have not really met him and talked to him.
Okay. Let's talk about what it's like to be the chairman of the Fed. One day you're a private citizen, and you can go to a restaurant, you can say whatever you want, you can do anything socially. When you're on the Fed board and then you become chairman, are you constrained in who you can socialize with, what you can say at a restaurant? if people come up to you and they innocently say, hey, what's going on? What are you working on? What are you supposed to say? I mean, so how is life as the chairman of the Fed?
So people don't come up and say inappropriate things. That's the thing, you know. In fact, mostly they don't come up at all. I think even people that I know are reluctant to come up, which is unfortunate because I like to talk to people. But I haven't had any situation where people have asked anything inappropriate, even sort of unknowingly. You know, but it is a different. You have security, and you know you have to be very careful about what you say in public places. And you know, it's just part of this life. Is the things you can do are limited, and you just have to accept that for the time that you have this job. But you know, it's such a great job, and it's such an honor to do it. I really don't think about that.
So if you want to talk to somebody on a cell phone, you have to have I would assume, a secure cell phone and so forth, and all of those things, right?
Yes, yeah, and you know, and 24-hour security and all those things.
So when you are running the Fed in a pandemic, are you doing it remotely from your home? I know you're now in the Fed building now, but have you been the last year or so mostly working from home, or have you been coming into the Fed and working from there?
You know, we had a pretty significant FOMC meeting on March 15th, which I think was a Sunday, and that was the last meeting that I did from this building. That I went home after that, and since March 15th of 2020, have mostly worked from home. And although lately I'm coming in, I find myself coming in 2, 3, 4 days a week, as a matter of fact, more than I used to. I'm not sure why that is, but that is the case. And I would tell you, it was surprising how well our business and our business model were able to adapt to doing work remotely. I think many organizations had that experience. We certainly did.
So most of the Fed staff people who work at the main building of the Fed, are they coming in now more frequently, or are they still working it from home?
Almost everyone works, just about everyone works from home exclusively, or you know, from wherever they are exclusively. Some people live elsewhere now, or they're calling in from a home someplace that isn't the one they have in the Washington area.
You're coming in more frequently because your wife is saying, finally, it's time to get out of the house and go to the office more, or some of that, or she's happy
there
for you
may
to
be some
stay
of that involved. There may be some of that involved, absolutely.
So how do you coordinate with the heads of the central banks in Europe and other countries that are important? Obviously, it's remote now, but do you find that you can still communicate with them what they're doing, and do you communicate as well what you're doing remotely?
You know, it's a very, very important part of the job, more important than I had really understood, I think, before I started doing it. And we need to know each other. The heads of the major central banks need to know each other pretty well and meet regularly and talk. And so that's what we do in Basel, Switzerland. 6 times a year we go to Basel, and we have 2.5 days of meetings, and there's no press or anything like that. So that's what we do. Of course, we haven't done that since January of 2020. So we're doing it by telephone, and I really highly value those interactions, and I know my international colleagues do too. So we're doing it on the telephone now, and by the secure equivalent of a Zoom call. It's fine. That's what we'll keep doing for as long as we have to do it that way. I'd say it's better to be in that tower in Basel, having lunch with people, seeing people in the hall, going for walks, and there's just more time to really meet privately and talk than there is on the telephone. But I stay in touch with a good number of my international colleagues, and again, I place a high value on it. I think that is a good thing to do.
The Fed director for the area of that housing, I guess, includes Wyoming, often holds an event, I guess it's in August or July, where the major finance people come together in Jackson Hole. And that's, again, July or August. Is that going to happen this year in person, or you think it's remote again?
I think they're thinking about that right now. So that's the Kansas City Fed, and our great Kansas City president, Esther George, will be making that decision. I'm not sure where they're going to come out on that, but it'll be held virtually, I think, as it was last year, at least in person.
I think you said recently the biggest problem that you're worried about now is cyber attacks and so forth. Can you elaborate a little bit more why you are so worried about it, and how does the Fed protect itself? I assume you are subject to lots of people wanting to know what's going on in cyber attacks. I assume you've got great ways to prevent that, but could you give us, without telling secrets you can't tell, some of the things that you were worried about in terms of cyber and how you protect your information.
Sure. The question I was answering was really, will we see a rerun of the global financial crisis with the banks failing and all that? And, we spent 10 years, literally 10 years, strengthening the banks with much higher capital. I can't stress how much higher levels of liquidity, much better risk management, severely adverse annual stress tests. And I have to say that the banks held up to what was a pretty significant real-time stress test over the course of 2020. So that isn't the main concern I would worry about it. And it really is some kind of a cyber attack. So we have a great game plan now for banks making bad loans and, housing bubbles and things like that. We've got that game plan. We've got a really strong financial system and capital markets. Cyber is just it's the new frontier. And that's not a new insight. We spend a great deal of time and money, making sure that we are resilient, making sure that the banks, they spend a lot of time and money. All of these institutions are, constantly under cyber attack. And, there's within the government, tremendous resources, very, very capable resources that we work with. I wouldn't want to go much into it, and historically we've run these exercises sometimes, scenario analysis, where we run an exercise and see how it happens. We imagine that X happened, and then we get together in a group. So we'll keep doing that, I'm sure. But as I said before, it's one of those things where you never feel like you've done enough.
Hey, let's talk about fintech. Since you first got into the financial world, the fintech revolution has really changed banking and financial services. How does the Fed regulate some of these new fintech companies that are really not subject under the traditional rules to your regulation? Are you worried about your inability to kind of control some of these companies that might have an enormous impact on the economy?
Yeah, I would say it this way. First of all, innovation is a positive thing. It brings with it many potential benefits: greater financial inclusion, more efficiency, greater options. Technology can do terrific things. In the financial area, the key thing is that equal activities, the same activity should be regulated the same way, no matter where it is, what kind of business it's in. That's one thing. Another is it needs to be regulated in a way that gives consumers and users of that service the protections that they need. And so they have to understand what the risks are, what they're doing, and that sort of thing. So I think with the growth of the non-bank financial players, we have some work to do to understand and deal with those challenges. In the meantime, we have the legal authority that we have over banks, really, also over some of the payment utilities, and we'll use that.